Always, I'd like to thank you for being here today. Today we've got Trevor, better known as T123 Knight, on the forum. He has a journal called the Wyckoff Speculator. It's been going on for quite some time. It's actually close to about 150 pages on the forum. Really great content. Actually, that's why I invited Trevor to do the webinar in the first place. So we've aptly titled this webinar the same name, the Wyckoff Speculator. Now, Trevor has a very detailed outline, so I'm going to only mention just a few bullet points that we'll be covering in today's webinar. And that includes defining context per Wyckoff, entry techniques using Wyckoff. Trevor also wants to talk about the impact of trading psychology. And then at the end of the webinar, we're going to take questions and try to answer everyone's questions. So Trevor has asked that we're going to take questions and try to answer everyone's questions. So Trevor has asked that if you have questions along the way, to please hold them until the end. So I will ask the same. So whenever he's finished with his presentation, then we're going to open it up for questions, and we'll do our best to get those answered. As always, this webinar is being recorded, and I will post the recording on VMT in the usual spot sometime tomorrow. Okay, guys, give me 1 second, and I'll be turning things over to Trevor.
There we go. Can you see that okay?
Yeah, it looks good. All right, thanks,
Perfect.
man.
All right, thanks, Big Mike. I'd like to thank Big Mike for inviting me to speak with you guys today, and I'd like to thank all of you for coming, and I hope that you can benefit from what I have to share with you. A little background on myself. My career began almost 17 years ago when I decided to quit my first job out of college, and I disliked corporate America and was looking for some entrepreneurial opportunities. So after reading an article in Inc. magazine about block trading and the SOES bandits, I decided that was a career for me. So with no debt or obligations, I decided to give it a try. In the beginning of my career, my trading styles varied from swing trading to scalping stocks. At one point in my career, I was trading close to 1 million shares a day in applied materials, and I think it calculated it was like 10 to 11% of the volume. However, over time in decimalization, it kind of became more cost prohibitive to make money that way. About 4 years prior to that, I had started a prop day trading firm with a fellow trader, and so after scalping lost its advantage, I kind of focused most of my energy on the business and starting a new family. And about 4 years ago, my business partner and I decided that the business model was no longer viable or worth continuing, so we shut our doors, and I started to put my efforts back into trading. I've been a serious student of Wyckoff for a little over 2 years now, and I got my start with the VSA Club, and from there I took various courses from Dr. Gary Dayton, and I believe the bulk of what I learned was from him and his Wyckoff Mastery course. It's a really great course if any of you are interested. And I spent a lot of one-on-one time with Gary, as well as David Weiss, too. And I think most of what I know about Wyckoff comes to these two guys. So anyways, enough of that on my background. Let's go ahead and get started.
Yeah, Dr. Gary is great. He's been on several times. So we always like him to. Have you seen his webinars on VMT? I think he's probably done maybe 5 webinars total, but probably half of them focus on psychology and half of them on Wyckoff. So he's always great.
Oh yeah, he's excellent. I think he is the most practical teacher there is. A lot of guys that teach sometimes aren't as practical, but especially when you do a one-on-one sessions with him, he's really good at diagnosing problems that you may be having. Is it a psychological issue or is it a technical issue?
Right. You mentioned VSA, so volume spread analysis. Now, I'm not personally a Wyckoff guy, but I think I know enough to know that some people consider VSA as not part of Wyckoff, and some people think that pretty much any kind of volume analysis falls into it. Where do you stand with that?
Yeah, it's kind of, it's not pure Wyckoff. I kind of would stand on that side, but it is based on it, and it takes a lot of the same concepts and ideas. And I think Williams took a few steps forward, I think, and added a lot to the whole whole conversation, I guess you say, when it comes to Wyckoff. I think David Weiss has done the same. He's added, and I'll get to that later, the Weiss wave. He's added a few things to Wyckoff it's based in it, but it's kind of taking it a step further. You know?
Right.
But I would probably agree with that. But I don't use VSA as much. I don't have the software. I don't really use it. But a lot of their ideas, like the no supply test bars and various things like that, I'll look at on a 5-minute chart.
Okay. Thanks.
So, oh yeah, no problem. Anyways, there's 3 topics I'm going to cover tonight, if time permits. I break trading down into 3 major areas of focus. In order of importance, I place psychology number 1, context 2, and entries last. And for whatever reason, I think most traders place their focus on entry and they neglect psychology and context. And I've been guilty of this myself. However, I truly believe it's the least important. And Gary mentions a lot in his course material that it doesn't really matter how you get in, but it is important to know that you want to get in. And that's where context comes in. It tells you, I want to be in this trade, going long or short. And then you go to your entry system to get in. Entry is last in the totem pole when it comes to this. Anyways, I'll move rather quickly through the entry part because I want to focus more on context. And if there's enough time, I'll try to get a little more into psychology too. Once my context is determined, entry really should be automatic. You don't need to think about it. You don't question it. You just get in. So I only have 3 techniques I use on a regular basis. Each one is 100% objective. Some of them are Wyckoff. One of them isn't so much Wyckoff, though it can be kind of seen that way. There's springs and up thrusts. That's my favorite. Second favorite is the 310 oscillator. And then I use the Weiss wave. If none of the other things are setting up and I've got great context, I'll use that to enter. Again, I'm not going to run through I'm going to run through these fairly quickly just so you get a taste of how I enter the market. However, I believe if you have a good understanding of context, you can use any entry style you like as long as it's objective in nature. So, not that I'm a fan of moving average crossing systems, but if you've got a good context, I think momentum indicators work better if you have context backing you up. I think your win percentage will go up as well. The term springs and upthrusts was not originally coined by Wyckoff himself, but his student by the name of Bob Evans came up with the term. However, I believe the general idea of them was alluded to in Wyckoff's work. The idea is relatively simple. However, there are a lot of nuances to them, more than I can probably go into tonight, but it's important, once again, that you apply context to them, otherwise you may not get very good results when using them. The overall idea is that price levels are always being tested to see if buyers or sellers are coming back into the market. A spring or upthrust happens when a level is tested then rejected, indicating that buyers or sellers have dried up, allowing for the counter side to turn price back up or down. Of course, a picture's worth 1,000 words, so I'll just kind of show you some examples. I marked there's mostly upthrusts on this chart, but here's a perfect example. You have a relatively strong move. Just so happens it was a very high volume move. And for whatever reason, sellers overcame buyers and pushed price down. When you come back up to these levels where there's significant selling came in, you want to kind of see what happens. It does one or two things. It either drives through it with even more momentum and volume, or it does not, or it creates an upthrust like we have here. It goes above it, sellers come back and drive price down below it. And generally, one of the nuances of a spring or upthrust is you want to see low volume on these tests. It's telling you that no real buyers have come into the market when there's not much volume. If it's higher volume, it could still upthrust, but it tends to get tested. But anyways, that's a perfect example of one. Here's one that's not an upthrust. As you can see, we drive above it, and you notice how we close above it 4 different bars. So it's not being rejected. It's actually probably being absorbed at this point. So for an upthrust to be legitimate, I like to see it to happen within 2 or 3 bars, or 1 bar is even better. Here's a 1 bar upthrust. Here's a 2 bar upthrust, and I'll sell when it breaks the low of that bar. In this case, it took 1, 2, 3, 4, 5, 4 or 5 bars, and it never broke the low of that, so that wouldn't be considered an entry. 2, if you have a kind of a weak drive into a level like here, that's also a good indication, especially if it's low volume. Again, it was one bar, drops below it, comes back above it. Here's another up thrust. You can see we had a really nice reaction to it. We call this ease of movement in Wyckoff. That's where you have a wide range bar that closes near the low or the high. It's telling you it's ease of downward movement in this case. This bar would be ease of upward movement. But anyways, that's basically an up thrust in a spring. It's pretty easy to see, nothing super complicated. When you look at it this way, obviously there's a lot more nuances we can go into, but Gary also has a great webinar on springs and up thrusts. I'd recommend it for anybody who's interested in learning more about it. The second entry technique I use is the 310 oscillator, and a lot of you who follow me know I look at this a lot, and I'm always putting a little square circle around it. Linda Raschke uses indicator extensively and talks about it in her book, Professional Trading Techniques. So if you're interested in learning more about it, this would be a great book to start with. I believe it's free. You can get it online off her website. Gary Dayton is the one that really introduced it to me and taught me how to apply it using Wyckoff. And there's so many nuances to this that can really help give you an edge in trading too. And if you're interested in learning more about it, Gary has a webinar. It's about a 2-3 hour webinar. He extensively goes over many examples. It's a very simple calculation. It's just a difference between the 3-period and the 10-period moving average. And I also have what's a 16-period moving average of the 310 as well plotted, and this is used to determine the overall trend. For instance, if the 16 MA is greater than 0, the market is in a bull market. If it's less than 0, it's in a bear market. So if the 16 MA is above 0, we look to buy once the 310 dips below 0. So it's telling us that price has moved away from the mean and it's on the tail end of the normal distribution curve. And basically the odds favor it's going to go higher. It's basically a pullback tool. You're looking for pullbacks to get long in the market. So again, if you have context going for you, maybe you were springing a major support level and we got some momentum going for us. This is a great tool for trendy markets. And here is an example of it. As you can see, the 16-period moving average is the blue line. So when it's above 0, it's in a bull market. When it's below 0, it's in a bear market. So here we know it's in a bull market. Say we have context. When it dips below 0, I enter either on a key reversal bar. That's a bar that has a tail on it, kind of like here's a key reversal bar on this one over here. Or I wait for the oscillator to turn up and I'll just jump in the market. And so anyways, so it's pretty basic. It's easy to see. It's very visual. Though one thing to point out, you can see this whole section here. It's kind of in a trading range, and it kind of works, but it's not great. So you can see you don't want to use this just exclusively by itself. You really need context to give you good solid signals. Otherwise, you could just be spinning your wheels. So I generally don't look at this until the very end. Once I've done my analysis, I've got context lined up, then I'll start looking for signals on here. And I just take them. I don't even think about it. Here's another example too. This one doesn't go above 0 totally, but it wouldn't be technically a signal, but this is an example where you can push it a little more when you have context going for you. I actually took this trade. I took this short. I can't remember what date this was. You can see the little hash marks. And I got out around here when we broke this trend channel. But as you can see, it gave me many signals throughout the day. There's 1, 2, 3, 4 trading signals you could have taken. I took 3 of the 4 on this particular day, but it's a really great tool, again, if you have context. The last one I'm going to show you or talk about is the Weiss wave. Now the Weiss wave is also great for developing context, so it has more than just one use. But for now, I'll focus on the entries. It was developed by one of my mentors, David Weiss, and originally applied to point and figure charts. It's one of those things where it was alluded to in some of Wyckoff's work, and David was able to develop an amazing indicator based on these ideas. And I have to say, it's by far my favorite of any indicator I've ever used. If you want to learn more about it, David has a webinar on this too, where he goes in a lot of detail, and his website has a lot of information. He also has a newsletter too, where he'll occasionally pull that out and talk about a particular setup he's seen on the day. So I've spent a lot of time with David too, and I'm still learning new things about it. And it's a really great tool. It's a lot of fun to look at, and it's really neat when you see things happen that you expect to happen based on this. Anyways, Wyckoff always encourages students to think in waves. There's one example in his work where he would total the sum of the volume on one point and figure wave, and he'd use it to pick up on hidden supply or demand. Supply or demand you couldn't pick up on, say, a bar chart where you're looking at each individual bar. Now, David, what he did is he did something pretty ingenious. He took a zigzag indicator, which is based on point terms, and then summed the total volume in each of these waves. So most of the time this is more than one bar. The advantage is that it reveals hidden volume that only looking at bar by bar volume charts can't do, and also allows you to use it on tick charts. It's really pretty cool. Oh, Big Mike, too. You know, if people have questions, you know, go ahead. Feel free to ask any if you like.
Okay. Okay. So, guys, if you want, you can go ahead and type some questions. I think that most people have been sitting on their hands.
Okay.
We do have one comment. Wayne was saying top of trend channel. I put a link in the thread for anybody that wants to download the 310 oscillator, and then I put a link to David Weiss's website for the Weiss wave. And I think that some people have tried to code similar concepts, so you can probably find some indicators on BMT for that.
Yeah, I think one of the guys I talked to has done that, and he put it up there. Yeah, it's pretty cool. I think they have it for NinjaTrader and TradeStation and multi-charts.
Yeah, Sierra Chart has something similar too that they came up with. You know, they don't call it that, but it's kind of similar. I had a question for you. I think I noticed that you're charting weeklies on the last chart. This one is what, 5 minutes. Do you have any thoughts on, you know, people that try to apply the same methodology to a lower time frame, like if they're a day trader and they want to be flat at the end of the day, or is it okay to use this on 1 minute charts or on, you know, some other chart type like a range bar or a Renko bar?
Yeah, most definitely. David has actually used it on Renko. He actually has another way he looks at Renko charts. It's pretty ingenious, really. But you can apply it to Renko. You can apply it to point and figure charts. I use it intraday exclusively, so you know you can go as fast a time frame as you like. You know, I look at I use 1,000 tick chart on the Nasdaq and a 3,000 tick chart on the S&Ps, and that's what I use for entering. And when I was looking at crude oil for a while, I was trading crude oil. I looked at an 800 tick chart, so you can use it for faster time frames. It works great on tick charts because it's not really effective doing bar by bar volume on a tick chart, right. So you tend not to have any volume analysis on it. But this gives you a way of looking at volume on a tick chart.
But you still need a chart that, like a range bar, for example. There's no tails, there's no wicks. So I'm assuming that you prefer a chart that is not like that. So you know, not Renko, not range, but something like tick or volume or minute based, right?
Yeah, that's what I prefer. Yeah, I do have a Renko chart up, and I look at it. I've got a little program David gave me that sums the volume in each brick, and so you can use that for doing some analysis. But I don't use it very often. I use this pretty much 95% of the time.
Okay.
Actually, I'd say 80% of the time I'll look at the Weiss wave. The other 20% of the time I'll look at a 5 minute chart and look at bar by bar volume, usually after I've gotten in a trade. It kind of helps me figure out when to get out of a trade.
Okay.
So here is, just so you guys understand what it is exactly, like here's the zigzag indicator. And every time it turns up, it starts to sum the volume in each bar until it turns down. So as you can see, from this bar to this bar, it sums the volume. The total is at the very top right. Obviously, each bar, it adds a little bit more. And one thing to point out is you can see if you're looking at the 5 minute bar volume, you can see it's not really showing you much. It actually looks like it's a light volume rally. You kind of think, oh, wow, it's kind of anemic. But when you have it totaled this wave, you can see it's very significant. In fact, this is the highest up volume we've had on this entire chart. So it's very useful. You wouldn't be able to see that otherwise. Now for entry, I don't use this for entry. I use this more for context. When I see that, I'll go, oh wow, there's some buying coming in. those of you familiar with Wyckoff, this is climactic action. See the spike in volume, so off super hard, and then we have the first reaction, a test, and we move up. So that would give me some context. But I look for no supply entries. This is kind of where VSA kind of use some of their ideas. I use it sometimes in the 5-minute bar too. But we had a no supply test here on top of a support. So this would be a valid long right here. And here's another no supply.
Sorry. I see somebody asking about the lag in the Weiss wave. So you said it's built on zigzag, so I know zigzag pretty well. There's like a different swing strength type of a setting that you can set, right? So there's going to be, before it identifies a new up or down, there might be, what, 2, 3, 4 bar delay?
Yeah, it depends on how, I guess, how fast it is. Sometimes, and the most it'll be on the NASDAQ, I notice, will be 2 bars, but usually on the first turn bar, it'll do it. Like, for instance, on this one where I'm circling here, I doubt that doesn't look like that was a very high close, but probably you would have entered on this bar if you waited for a turn in the Weiss wave to go along here.
Right.
On this one here, I wouldn't have taken it till it closed the high of this bar. So, I mean, it moved quite a bit before I would have gotten signal. So there's some lag.
Right. So you got to keep in mind that if you're on the far right edge, this indicator is going to be, 2, 3, maybe 4 bars, depending on your chart type behind.
Yeah, exactly. For instance, like on this one, like here's a great example. This just so happens to be a spring as well. You see it's springing this level. This bar probably wouldn't have signaled the zigzag, probably the second bar over. Looks like that was more like 2 points. That looks like a half a point. So you probably would have gone long. I don't know if you can see my cursor, but on this bar right here. So it's a 2-bar lag on that. Yeah, though you can anticipate it a little bit. I saw a spring. I may want to buy it when it breaks the high of this bar, so it might get me in a little early. But it's my least favorite for entry, so I don't use it that often. But if I really wanted something and nothing else is working, I don't care. I'll pay up.
And just so you know, we can see the cursor. It works fine.
Here's another example. Oh, you can't see. Okay, great, perfect. Here's the same chart. This is the tick chart of the same one. As you can see, it gave us even more entries. There's a no supply test there, and there. Another no supply. So you had plenty of opportunities to get in if I missed the spring, or there's a 310 oscillator trade here. Actually, I remember this day. I think I entered and got out here and entered back on this spring, but what gave me confidence was that no supply test. So it's a great little tool to have, just to kind of give you, the more it's hard enough trading and making decisions, but when you got things backing you up, it really helps. Okay, now on to the meat and potatoes, the real engine of success, context. I break context down into 2 areas. We got market structure, which is pulled mostly from Wyckoff, and then I look at something I call pivot points. It would probably take me 4 to 5 2-hour webinars just to cover all the Wyckoff concepts. So obviously I'm limited on what I can show you tonight. However, I will show you one of my bread and butter setups, and I call it the sequence for change in trend. Next will be pivot points. This is one concept I believe the majority of you can use tomorrow and benefit from. So no matter what your strategy is, not only is it extremely easy to apply it to your trading, it also gives you an added edge as a day trader. And there are certain things that we can use that have great predictive power, and I'll show you the ones I like to use tonight. Oh, well, let me go back one slide. Sorry about that. What we now look for is what Wyckoff has called a change of behavior. Well, I wasn't the right one. I'm sorry. I'm behind here.
No problem. You're doing great.
Okay. To truly use, sorry, I kind of got lost in my notes. To truly use this technique properly, you only really need to trust and understand how to use the trend channel. This is really key to understanding how to use this. Once this has been established, all the other pieces fall into place, and you start to look for signs of strength or signs of weakness. One of Wyckoff's concepts would be shortening of the thrust. This is where each progressive down movement or up move makes less progress than the previous one. I'll show you some examples in the next few slides Also, there's an overbought or oversold condition. This is when we're at the extreme top or bottom of the trend channel. Also, if we are unable to reach the top or bottom of the trend channel, this can also give us a clue as to the strength or weakness of the trend. This only puts us on our toes for the potential for a change in trend. We don't start to look at jumping on board quite yet. The market needs to prove itself before we're going to move in that direction. What we now look for is what Wyckoff calls a change of behavior. And this is where the Weiss wave actually comes in handy. One example is a violation of the trend channel. And it's also interesting how many technicians look for the same things but call it by a different name. I'm actually reminded of Thomas DeMark and his qualified trend line. I'm not sure if many of you are familiar with his work, but it's almost always seen as a violation of a trend channel to a Wyckoff technician, at least to me. And it's one of those, this only validates its effectiveness to me, since others outside the world of Wyckoff have noticed this tendency. Second, we can also look for, so it's kind of an amazing thing to see, but after that, we also look for high volume moving in the counter direction of the trend. Preferably, we like to see it as the highest since the trend move began. Again, I'll show you some examples on a chart. We also look for counter waves. Once these pieces fall into place, you look for pullbacks on low volume or tests to jump on board. Now there are many different combinations of these elements, and I'll show you three that I happen to see quite often, but really there's a countless numbers of them. So here I drew a conceptual map of three different scenarios to show you guys. Key is first to drawing the trend channel, and once you've drawn the trend channel, then that's really kind of your anchor for how to make your analysis. I don't show the pivot high here, but you basically take the beginning of the move and you look for a lower high and you connect the two, and then you draw a parallel and move it to the low point to the left. And this draws your trend line. Sometimes you have to redraw them if the trend continues. And there are times where trend channels just aren't useful, especially in a runaway market. They just don't always are very effective, but most of the time they work pretty well. So what you do is you draw the trend channel and you kind of watch for the market and see if it's continuing in its downtrend. And you look for what Wyckoff calls signs of strength to come in. And there's a lot of other different elements that I'm not even talking about tonight, but two of them that I can show you that are fairly simple ideas is shortening of the thrusts. That's where each progressive down move is shorter than the last. So we have this move here. It's a pretty large move. And then once it breaks the swing low, you measure the move from here to there. So you can see it's a down move, but it was slightly less than the previous. You get and I usually like to see three waves before I start assessing shortening a thrust. Here's the third wave. It breaks lower, and it's even less progress than this wave or that wave. So it's telling you that momentum's slowing. Each progressive down move is making less progress. Another thing to note is we can't make it to the bottom of the trend channel in this instance. So I'm not necessarily looking to go long, but I'm like, okay, if I'm short, I might tighten up on my stops. And once you get a change of behavior, which is this could be one of many things. It could be the violation of this trend channel, which it did. And generally, it's accompanied with high volume. Also, too, you can see this is the largest upwave we've had since the down move began. So it's showing you that the buyers are starting to step back in. And then what you look for is generally a low volume pullback to go long. And this is where indicators come in. You know, this is where I'd use the 310 oscillator, or I might use a spring. Maybe I don't have a 310 oscillator trade, but I see a spring sets up on my time frame. This could be on a higher time frame. It could be the time frame of the chart I'm trading. So this could be on my 1,000 tick chart, or it could be on a 3,000 tick chart. And it's actually better when it's on the bigger time frame. Then I know I'm probably going to get a bigger move. So really, you can look at any time frame you'd like to kind of look for this sequence.
And Trevor, actually, that's a good question.
Here's another example. This is one where we.
Sorry, I don't mean to interrupt, but time frames is always a. But let me ask it this way. So you have multiple time frames up, okay? But do you have, okay, let me back up. I consider it very dangerous to actually trade different time frames at the same time. Now, looking at different time frames is very useful, So what I mean is like trying to find setups or entries across multiple time frames, because often what you'll be left with is conflicting advice, right? So how do you handle it? Do you have like one entry chart and then you look at the other charts to support that, or what's your thought process?
Yeah, that's a good question. Yeah, because I've struggled with this in the past too, and you know, I kind of find when I go, like, let's say I have a 1,000 tick chart as my main trading chart, and I see something setting up on the 9,000. It'll definitely change your bias, and you know, you can actually get hurt doing that. So you got to be careful. The way I kind of do it is my higher time frames. I look for real obvious things like a major resistance level, and I'll get into that later tonight. But like on a daily resistance, I draw that on my chart just so I have it and I know of it. And it's valuable to keep that in mind. But I'm not going to just short it because we're at a resistance. I need to see my smaller time frame give me some signals. I maybe can see something like this setting up on my faster time frame. But that's about it. You know, I always look at this. I look at my 3,000 too, and occasionally I'll take a trade on that. Like I did that today on the S&P, so I'll show you guys an example of the trade I took. But only time I really use it is for confirmation. So if I see something setting up on my 1,000, I'll look to my 3 or my 9,000 to see if momentum's going with me. And if it is, it gives me a little more confidence to stay in the market. Other than that, though, I try not to look at it very often.
And just so
I'm looking at 80% of the time, I'm looking at my 1,000.
Okay. And just so I better understand, are you primarily focusing on one market at a time, or 2, 3, 5, 10? What are you doing every day?
Yeah, you know, I'm focusing on 2 right now. I'm focusing on the S&Ps and the NASDAQ, and they're kind of correlated markets, so it's really kind of one market. I've tried doing 2, but I think my temperament isn't very good with that right now. I'm kind of down the line. I might do more of that. I'll do a swing trade on occasion. Okay. But it just kind of, you know, I think that's a preference. You know, I did take a psych course where the guy said, you know what, just trade one market. You know, you're putting too much on your plate. The stress of one trade will affect how you trade the other one. You know, and I find that out a lot. I may watch some, but I'm only in one at a time when I'm day trading because it messes with my head. I don't know about you.
Right. Gotcha. Thanks.
Yeah. So. Anyway, so, well, here is another conceptual map. It's kind of just showing you that you have different variations of all these different signs of strength. In this particular time, we got an accelerated move going into an oversold condition. Now, when it pulls back here, I'm probably thinking to go short. I'm not thinking we're going to go up at that point. But I'm looking at it and going, oh, we're oversold. Well, let's see what happens. And when we get this up wave here, and generally it has high volume, it's telling you, okay, maybe it's time to go long. Coming from an oversold condition, this is the largest up wave since this down move began, and you'll hear me say that a lot. That's something that David's pointed out to me, and it's really useful. It gives you a reference point to look at these things and lets you know when your antenna should go up. And let's say the Weiss wave has a biggest up wave since this down move began. It's telling you, hey, buyers are coming back in. Let's stay on our toes. This is building context now that you should focus on maybe going long. And if you get some long signals on the 310, or you get a spring or a no supply Weiss wave test, then jump on board. You have good reason to. You have a lot of sail, a lot of wind in your sail, as I hear Gary say a lot. And here's another one, just to show you another example where we didn't necessarily come down. It's kind of like the first one I showed you. We didn't come down, but we ended up springing off the bottom. And this is actually my favorite type of entry, because a lot of times if this is low volume and you're springing, you're getting the best spot price, and it's fun catching the low of the day. It doesn't happen very often, but it does happen. And this is a perfect scenario. You got shortening of the thrusts, violation of the trend channel, the up waves are starting to get larger, and you know, let's go for it. Let's take a bet here. And these patterns happen over and over again. It happened today. It's happened numerous times. This week's been kind of quiet, but Monday was good. But last week there was a little bit more activity. But here's a perfect example of one. Here we have a trend channel drawn. I kind of didn't draw it perfectly, but you get the idea. And as you can see, we're getting shortening of the thrust. We move from here to here, and then from here to here. They're getting progressively shorter. just so happens that we're at yesterday's low as well. So that's why I like drawing these things. It gives you added ammunition. You get a change in behavior here. This is the highest up move we've had since this down move began. And here you can see what I'm talking about. And the demand is strong. This is the most up volume we've had actually since the previous day. So that should tell you, okay, I should start looking to go long. And sure enough, I got a 310 signal, and I didn't get no supply test or spring or anything, but I got a 310. I actually went long on this trade. I remember this trade well because I didn't manage it well. I should have. When it up thrusted here, I thought, should I get out? And I ended up holding it down to here. But then I got back in and off another 310 trade because I have all this wind in my sail. We're rejecting previous day's low, and we have a new trend starting to begin. So here's another example of a spring trade, kind of like I showed you on the last conceptual map. We have an oversold condition, change of behavior. Now this happened the night before. I remember seeing this thinking, okay, there's some demand starting to come in here. Tomorrow we'll have to wait and see what happens. What piqued my interest was this demand on the Weiss wave. This is the most we had since the morning, and this move down began, and we were oversold, and we had this nice strong rally. So the next day, when we got a spring, that was a pretty obvious trade, and of course, turned out to be probably the second best trade of the day. This actual one would have been better, but as you can see, the context can really give you a lot of confidence too when you have that going in your favor. And here's today. I just want to throw this up. I actually took this trade. It's one of two trades I took today in the S&Ps. I had my trend channel drawn, and I noticed this morning just before the sell-off that we were up thrusting here. Now I did take a short here on my intraday chart because I had other reasons. I didn't catch nearly the full move. I think I only got out about here, but it was telling me that supply was coming in, shortening of the thrust, violation of trend channel, the largest supply we've had in probably almost 3 days. So on this pullback, and I decided I wanted to go short. And my faster time frame, this is when I switched time frames, my 3,000 tick chart wasn't giving me anything good to look at. It just looked messy. So I noticed that with tick charts, when things get kind of slow, sometimes it's better to use a bigger time frame. But when we got the 310 signal and I got a key reversal bar, I took this short, and I think I covered it at this low here. I didn't ride it all the way down. This one didn't produce a lot, but just goes to show this sequence of change in trend happens fairly frequently, and when it does, it really should put your antenna up, and it gives you a lot of confidence when you're taking your trade. Real quickly, I'm just going to show you David Weiss' conceptual map, just to show you how this particular change of sequence and trends happens. And as you can see, we have different levels of support and resistance. So you want to look at these. These are the ones you get off your daily chart or maybe your hourly or 4-hour chart. And you place these levels, and then on your trading chart, like my 1,000 tick chart, I would be looking at these levels and not necessarily shorting them when they get there, but waiting for signs of strength or weakness to come in at these levels. And of course, here you have a trend channel you could draw here. We violated it here, and this is the largest down wave since the up wave began. Probably some supply. You can shorten here. Same here. We break this trend channel. Big up move off of support. You probably want to go along there. If you're really brave, you could have probably taken a spring off this level. But it's just kind of nice to look at. I've studied this quite a bit when I first got it, so it's kind of forever etched in my mind. But it's just kind of a nice idea. David talks about when you go fishing, you always fish on the edge of the lake. You never want to fish in the middle of the lake. So same goes with trading. You want to fish on the edges of the lake when the trend is getting ready to turn. That's where the most profit is going to be. Now I'm going to move on to pivot points. Granted, these Wyckoff concepts that I've shown you might be difficult to soak in at first. However, it's a skill you can develop over time with practice, and I see these same patterns happen over and over again. And they lead to some of my biggest winners. Now with pivot points, you can easily take these, this is an area of context, and apply it immediately to your trading, regardless of your trading style. And that's kind of why I wanted to show you guys this, because Wyckoff takes a while to learn. The idea originally was introduced to me by Gary. he showed me how to integrate this with Wyckoff. And many of these ideas originated from Toby Crable. I'm sure many of you have heard of him in his book, Day Trading Short-Term Price Patterns. The book's out of print now. I think an original copy, it fetches like $1,000. However, I think you can find it free, a free PDF version on the internet. And he's done some extensive research on many of the ideas I'm going to show you, and he's got a lot more that I haven't even touched yet. But it's supported with backtesting statistics, so it's kind of nice to know that a lot of these things are, you can prove that they happen and occur. Linda Raschke also talks more about them in her book, Professional Trading Techniques, and if you're interested, I'd recommend you get that book and read about it, because she does a better job of simplifying it. I personally haven't read Toby Crable's book yet. It's on my list of books to tackle, but I think she does a good job of being practical and how you can use it and how she uses it in her own trading. Now these pivot points aren't the ones most of you think of that are calculated by certain mathematical calculations. These are more, I guess you would say, they're more time-based. And the four that I'll be covering tonight are previous day's high and low, opening price, first hour high and low, which I find that one extremely useful in helping me gauge the day and what to do, and major daily resistance as well. And here I have a screenshot of the daily chart of the NASDAQ, just to show you how often, as a day trader, how often you could use this particular, this as context. And you can see probably about 60% of the time it's context that's in play, and it works out most of the time. For instance, here, I guess I should back up. On the highs and lows, you look for one of two things. You look for them to either be rejected or us to drive through them. And it kind of makes sense because, you know, the previous high and low is where buyers overcame sellers or sellers overcame buyers yesterday. So either they're still there or they're gone. And if they're gone, then you want to go when it breaks out. When they're still there, then you know, I probably might go down and test the low again today. And so every morning I draw them on my chart. I keep an eye on them. For instance, here we drove above it and we trended and closed at the high of the day. Here we rejected it and we closed near the low of the day on this particular one. Here we broke below it, closed on the low of the day. Here when we rejected the previous day's low, and we actually closed on the high of the previous day. I thought that was kind of interesting how that worked out. So it's really simple. It seems simplistic, but it really works. And if you just use this one thing alone and just kind of at least watch it for a while on your charts, I think you'll notice that it's pretty effective in helping you at least stay out of trouble. You may not get any buy signals when it's rejecting a low, but you know, okay, well, maybe I should wait till we break below it to go short. That doesn't mean I won't short it if it doesn't do this, but I have to have a lot in my favor before I even consider it. But I think this is an added bonus for a day trader that a swing trader doesn't have this, where a day trader does. So I'll show you some examples. Here's one day where we had yesterday's low and we broke below it. And as you can see, we had ease of movement, lots of supply coming in. This is a day, you know, you might have shorted it here at the open, but if you didn't, you have a second chance when we come up and test it. I had a 310 oscillator to short here, another one to short here. So there are two opportunities to short after we broke this. But that's a pretty good context. Even if you don't know Wyckoff, there's a lot of Wyckoff things that would back this up. You know, we're breaking through ice and we're testing ice. There's all these different things we look at. But even if you don't have that and you've got a good momentum indicator you rely on, you can look at it and go, oh, yeah, you know what? We're breaking lows with some, and we've got a lot of momentum going down. Maybe this is something I want to short on a pullback.
And remind me, what is ice?
If you're using the
Is that just support?
Oh, ice. Yeah, it was a term coined by what's his name? I just mentioned his name earlier. One of Wyckoff's.
Evans.
Yeah, Bob Evans. And it was an analogy he used. He had really morbid analogies, but they're kind of useful. The idea is ice is like a support level. So he compared it to, I think it was a Boy Scout walking on ice, and he breaks through it. And he sinks down, and when he comes back up, because of the current underneath the ice pushes him over, he hits his head underneath the ice and then drowns and sinks back to the bottom. And
Okay.
so it's it's very morbid, but all of them are so morbid. I don't know why he's such a morbid guy, but
Yeah, Arnie had a good question. He's talking about the on the Weiss wave volume. He asks, isn't it normal if there's 15 bars made up of one move and there's only 10 or 5 bars on a different move? Isn't the volume going to be proportionate to the length of time or the number of bars it took to get there? How do you put that into play?
Not necessarily with ticks, because it's based on trades, not volume. You may get like you may get 2 ticks that have like 1,000 contracts. You just don't know. So not always. I don't notice that per se.
Okay, so you prefer to use it on a tick chart?
I use it on tick charts.
If you use it on I apologize for the delay on our audio, but like for example, if you put it on a 5-minute chart where every bar is constant, and one wave is 10 bars and one wave is 5 bars, it's going to be kind of difficult to compare the volume between the two, or what do you think?
Yeah, it can. I just don't look at a 5-minute that often with it, just because I don't get as many waves on a 5-minute, and I find it 1 minute just is too long. And I like the way the tick chart smooths it out for me.
Okay.
And it just looks cleaner. I know David uses tick charts, and he'll use a minute chart too. I think at his level, he can easily jump between the two of them and figure out which one looks best to him. At the experience level I have with it, I just stick with one, and if I miss something, I miss it.
Gotcha.
But I don't find it that it distorts that much. A lot of times it's pretty close to the 5-minute chart. It just depends on the activity for the day. So, and things you'll notice too, like here's a big down move. There's a lot of volume, and then the next wave has very little volume. These kind of things you may not pick up on a 5-minute chart just because it's not moving fast enough, whereas on a tick chart it does. So you can catch these nuances a little bit better. And so it may get you out of this trade. I do that a lot, especially if it's a big extended move. I get a down wave with lots of volume. The next one's really small and kind of flips around. I'll get out. But I hope that answers the question.
Thank you.
Well, here's an example of a rejection of yesterday's low. I think this was a weekend, but it just dipped down below it a little bit in the pre-market, but it sure had a nice lift off from that support level. So at that point, I have Wyckoff reasons. This is the opposite of ice. It's called jumping across the creek. Same kind of analogy with a Boy Scout trying to jump across the creek, and then and he lands on the other side. But I had a 310 buy here, here, and here. Then we drive above yesterday's high and hold it. Yeah, so you can go long on a 310 trade there and there. I might be thinking of shorting in here, but when we have this supply coming in and then we spring, I remember this day. I think I did take this long. I think I was short. I took a scratch on the short and I ended up going long here. But then I didn't catch any of this move. I was kind of this move here kind of made me think it was enough for us. But you can see there's no reason necessarily to short. I went out on a limb a little bit, but we never really rejected yesterday's high. It would have been a long mode all morning, no reason to go short. And it gave me good context to build on top of my indicator that I used for getting in here. And then, of course, I can apply a lot of other things to kind of give me some other ideas of what's happening. But if you just use this alone, it's really helpful and useful, and it's one of my favorites to look at. This one's pretty obvious, daily highs and lows. But I know a lot of some traders don't look at this. I know some good traders that I know that don't look at this. I know one guy that was in a trade, and he was showing that it was a good trade, but it pulled back on him 50%. And I just looked at a daily chart and I go, it was right at daily resistance from it's like 8 days back. And I'm like, why wouldn't he just take his profit there? He would have made a lot more money. So I just think it's important to have them there. Now you got to be careful, because sometimes we'll hit these levels and we might absorb them and go higher, but you can always get back in. I always exit all my trades at these levels. If I'm lucky enough to get a move to them, I get out, because I find only 10% of the time it'll blast through it and keep going. It doesn't happen very often. But I'll show you a daily chart again where it helps you. It may help you get into a trade earlier than looking at the previous day's high or low. Here we rejected a high from 2 days ago. Probably would have been good to short here. If you waited to yesterday's high, you might have actually wouldn't have been a great trade either. But you would have given up a little bit of profit. Here's another support level. Now here you can see it didn't necessarily give you a good buy signal, but it gave you a good reason to exit your trade once you're under this level. Here you can use the combination of yesterday's high and a resistance level to kind of anticipate an upthrust. When we reject yesterday's high, you could get short in here before it really penetrates this particular daily high. So I think it's just real important to have them on your screen. Here it breaks not only yesterday's low, but the major support level low, and just craters down. And this is one time where that daily support level didn't really hold. Also look at opening price too. This helps to determine the trend for the day. A lot of the times we'll open and then go from there, and we end up closing on the other end of the day. For the other end of the day, this is usually where early imbalances in supply or demand will show up. So ease of movement or strong volume off the open will increase the likelihood of a trend day. And so watching this opening price, I think, is crucial, because if it gets some ease of movement at the opening, either up or down, could give you a good indication what to do for the rest of the day. And I think it really sets the tone for the whole day. I find that after the morning, if I'm kind of confused what's going to happen, generally nothing does happen, and I'm probably better off not trading. So it's just a good thing to keep an eye on, have on your chart. You know, here's one where we drive down at the open and immediately drive back above it. And you have other things. You have a yesterday's low that we rejected as well. But it's letting you know, especially when you have demand on the Weiss wave coming in as well. Well, you know, we may come down and test the opening price, and I might want to go long when we come in and test that level. I like that's a really great trade, especially when you've got an indicator lining up with you, which happened here. I think I scratched this trade. I can't remember why. Didn't manage out of it very well, but at least I caught it. As you can see, I didn't even attempt to go short. There was an upthrust here. Would have given you a little bit of money, but you know, we're coming from a support level. I'm more likely going to get a big up move than a big down move, and I might wait for us to drive through that bottom before I'd consider going short. So all day I was going short until we hit a daily resistance level here. As you can see, it marked the high for the day. That's why I like to get out at these levels. On this trade, I actually held it to there. This one, I think I covered half of it because I did add on, and I ended up covering it for nearly a flat. I still kind of regret that one. But as you can see, the opening did a great job of kind of giving you an idea where the trend for the day was going to be. Here's another example. We drive through the opening price. We actually almost spring down here through it. Sometimes I like to try to anticipate. If I get a nice spring or up thrust, you can usually get in at a good price just before it moves. But again, here we hit a daily high, we stopped, and we broke above it and held the daily high. Another reason to watch these daily support and resistance levels. Here's another one where we move strongly off of the open. We come up and test it, and we get an upthrust right at the opening price. And I think it's a psychological level that all of the floor traders have, and they're looking at too. So if it lines up with a signal, take it. Then again, it's not a signal in and of itself, but it's something that's really good to look at. Let's see here. So the first hour of trading range, and I don't know, I think Gary said this, I'm not really proficient with market profile, but he seemed to think that some of, and I know you look at this, Big Mike, but this might have a little market profile in it as well. But the first hour trading range generally establishes the framework for the rest of the day, and it helps me gauge my expectations. About half of the time we break out and close at the extreme of the day. The other half of the time we just stay within that range. And so there's some really great predictive power to this, and it can really help you gauge, one, when we're in a trend day, two, when you should be taking profits a little quicker than normal. Usually you can kind of anticipate us closing at the extreme of the range of the day when you either get a strong drive off of the open, generally in the first 15 minutes. If it's extremely heavy volume, especially if it's greater than the previous 7 days, this is telling you there's a very high likelihood of a trend day. So this is pedal to the metal. This is when you add on to your positions and you hold them as long as you can, short of some major technical reason to get out. Or we break out of a narrow opening range, usually the first 30 minutes. We have a good, narrow, really tight 30-minute range. We break out of it. Then if we start lifting out of the first hour range, not 30 minutes later, then you know it's probably going to close in the extreme end range of the day. The rest of the time, if it's just a low volume morning and we develop an hour trading range, we haven't done anything, a lot of the times I just try not to trade at all. And this is very valuable for me because I come from, I mentioned that I used to trade a lot in stocks, scalping stocks, a lot of trades. And so I have this impulse to like, I feel like I need to trade. This really helps me kind of pull the reins in and say, hey, first hour is not doing anything. Let's just step back and wait for it to break out. And even if it does break out, maybe if it doesn't have any follow through, I'll short on an up thrust to come back into the range.
There is a lot of similarity there with market profile terms, the initial balance, opening drive, opening test drive, etc. And just so everybody knows, there's a really fantastic thread. If you do a keyword search for homework, you'll find a thread called Master Homework and Statistics or something like that. And there's a lot of work in there that people have done to analyze, like what you were just talking about, Trevor, on percentages, like how many times, you know, the initial balance low or the initial balance high, which is the first hour range, will be tested or broken, and et cetera, et cetera. So it's really good to know these statistics.
Yeah, I think they are really helpful. I studied a little of Larry Williams too, and he does a lot of that kind of statistical analysis, more on the swing side than day trading. But any little edge you can get helps, and it leaves less for you to decide during the trading market. You know, the less decisions you have to make, the better. If it's there and it's obvious, those are the best kind of trades. So here's an example. I squared in the first hour, and as you can see, it's not a lot of bars on a tick chart, so that's telling me it's pretty low volume. And I actually remember this day too. We broke a low, so that was a short for me. And once we kind of got into here and it started bouncing around, I think I got out on this drive up here and didn't make much on the trade. And at that point, it was pretty obvious that we were in a trading range. Now, if you're in a trading range, you can maybe short an up thrust here and get lucky. But for me, I tend to not do anything. You know, when you get a break, you should always take a break from trading anyway. So if you have a good excuse not to trade, just take a break, go for a walk, come back at the close, see if something happens. Here's another example of the first hour trading range. And as you notice too, when we try to break, it's just there's no follow through. There's no supply coming in here and here, and so you're probably thinking to yourself, well, I probably don't want to go short. Say, I probably wouldn't take this short at this point because there's just no follow through breaking out of that range. This was actually, I believe this was the Fed day, so that's one reason why it was so quiet. But when you start getting springs down here, you're not right at the low, but the first hour low, but you know that, hey, it's probably not going to go very far. So it might be a good, chance to jump on board. And as you can see, we tested the opening price 3 times and then turned back down. So there again, how it's really good to have these pivot points on your screen just to help you better, analyze and gauge your expectations. So, because if I was long here, which I wasn't, but if I was, I probably would have exited around the opening price, especially since we're so near resistance, a particular trade. Here we have a first hour trading range. You can see we had a big drive down, and then we broke through it. So once it breaks through it, it's a pretty good idea to go short. Now, I probably would have taken this one in anticipation just because we did reject yesterday's high with some good solid supply, and I got a 310 oscillators trade. So I probably would have taken this and maybe even added when it came up into this area. But again, the first hour range is really good at kind of helping you figure out what happens. We did close near the low of the day. Here's another example. We come down kind of bop around inside this trading range and then break out and pull back and test it. So this is the spot to go long, especially when you have such a strong move like this. Here's a no supply test, yet demand comes back in, biggest up demand since this down wave began, so buying a no supply test would probably be worthwhile taking. So, but anyway, so that's it for context. I kind of gave you guys a really quick version of it and gave you just some good basic understanding of what I look for when I trade. So, more than welcome to come and comment on my my trading journal. I'd love to hear your feedback. If you have any questions, feel free to ask. Most all my trading is based on what I've showed you tonight, and there's a few extra things that I didn't get into that I look at that are more Wyckoff based. But the majority of what I showed you tonight is what covers my trading. So there's no mystery. So when you see when I get in a trade or get out of a trade, you generally know why.
There are a couple of questions.
So I guess if we have any time, I can quickly just go over some.
Sorry, a couple questions maybe before we get into the psychology. So let me see here. Royal Flush was asking about today. I don't know if you have a chart of today, but about the supply coming in today. And
yeah.
Any comment on that?
Yeah, let me look for it. I think I have the chart here. Was that it? I think it's this next chart. There we go. Yeah, this is a perfect example. This was on the S&Ps, and it was on the 9,000 tick chart, which I generally don't take trades off of unless it's really obvious. And it was a perfect example. Here you see the supply on the Weiss wave. So I think I use a 2-point on this 2-point reversal. No, actually, I think I use a 1 or 1.5 point reversal on this particular chart. But when we reversed here and came down, it was a pretty solid move. We had ease of movement down. So it totaled the volume in all these bars. And as you can see, this is the most supply we've had since this up move began. And actually, in the last three or 4 days, it's the biggest supply that's came in. And not only did we reject yesterday's high, which is another pivot level I looked at, but this is the biggest downwave we've had in 3 days as well. So it was pretty obvious to me that I wanted to go short, and I actually shorted it twice. First time I was trying to anticipate a little early, and I think I lost about 0.5 point on that trade. And then I jumped back in here, and it looks like a bigger move than it was, but I think it was only about 2 points to here that I got out of it. So I only made like 1.5 points, but it was a pretty obvious trade for me, because not only did I have this context built, I had this violation of a trend channel, shortening of the thrust in the background, and a change in behavior. Like, I was not even thinking about shorting up here. I was thinking, oh, it's probably going to go higher. But once this came in, my antenna went up, and I kind of went on the short train. I'm like, okay, I'm going to look to short as soon as I can.
Okay.
And when I didn't get a signal on my 1,000, I went to my 3,000, I went to my 9, and that's where I got my 310 trade short.
Matt was asking the question.
I'm not sure if that answers his question.
Yeah, I think so. And Matt had a question about why you choose NASDAQ versus the S&P. Is there any reason they prefer one versus the other?
Yeah, I actually had a session with Gary last week when I kind of talked to him about this. It's kind of preference. I like how the NASDAQ moves. It's just kind of a personality thing. I like when it moves really quickly, and I think it has slightly better risk-return ratios, at least right now. So if I'm risking like $1 in the S&Ps is probably like $2 in the NASDAQ. So if I'm risking $2 in the NASDAQ, I'm making 10 points on a really good trade pretty easily. So that's a 5-to-1. On the S&Ps, it's probably 3 to 3.5. I'm finding lately, and so that's why I choose it. However, the S&Ps is a little smoother, and it tends to move a little bit more methodically. So in that sense, I think it's better than the NASDAQ, but it's kind of a preference.
Okay. Gary was asking whether or not you're using default settings for the Weiss wave, or have you set some custom settings?
Yeah, I set custom settings. I just change it to whatever time frame I'm looking at. So, and a lot of it's eyeballing it. Like, now this just looks clean. You're getting nice moves. But when you got like 6 one-bar reversals, then you know you probably have a little too short. So it's one of those things you kind of have to adjust it to whatever looks right, and then you may have to adjust it later. I haven't had to adjust my settings for a very long time. I kind of keep them where they're at, but it's kind of a preference, so I do change them.
Okay. And it looks like the only other question right now is from Jeff. He's asking what the moving average is on your chart.
Oh yeah, I have a 20-period exponential moving average, and I use it just to kind of Gary says that it makes a great surrogate trend line if a trend line is not looking very useful. So, for instance, yeah, like if the market's really moving quickly, yeah, you can't really draw a trend channel on that. So the moving average just kind of is like a surrogate for that. So when it pulls back to it, you're like, oh, great, it's touching the trend line.
There is one other question from Wayne. He asks, do you mark up zones of supply and demand with lines?
Yeah, I kind of look at areas like, for instance, I don't have my charts up, but let me find another chart that might be. I mostly draw support resistance lines, so like I might just draw from here across. But you do have zones that I look at, like this general zone in here. I mean, when we get up in here and it starts acting weak, you're kind of in an area where there's been distribution. So I do kind of do that. I might box it off so I'm not so tunnel visioned on one level. If it doesn't get there, I don't consider it. Sometimes you miss out because it could be a general area of distribution. So I mark that sometimes with usually with a block, but only when I'm in a trade. Usually when I'm in a trade, I'm looking to get out, I tend to do that. When I'm looking to initiate the trade, I like to really see it cleanly test a level, but that's just for that's my own preference.
Okay, I don't think there's any other questions right now, so we should, I guess, move to the psychology. Thanks.
Yeah, and I'll just touch on this briefly. More than anything, I just want to bring it to people's attention that it really is, and I'll kind of talk a little bit what I do and kind of the references to things that people I've learned from. Most of this is from Gary, a little bit from Trading in the Zone, and some other books that I've read. Linda Raschke actually touches a lot on psychology too, and she's really practical in how she applies it. I don't think she totally knows all the maybe clinical reasons that Gary might know. He's very, because he actually has a psychiatry degree, but she's really gives good advice. And so I just want to bring it to people's attention to look at this stuff. It's important. I think for many reasons. First is self-assessment. I think is really not is kind of downplayed by a lot of people, and a lot of it's a defense mechanism. I mean, that was what I used to do, and it wasn't until I really decided that I could be wrong, and I got to push my ego out of the way and just really look at what I did and not try to, come up with excuses for myself. And you do it automatically. It's kind of subconscious. You don't even realize it. And the best way to do it is to journal it, is to journal what you're doing and then really look at it and be brutally honest but not brutal to yourself. You don't want to be beating yourself up, but you want to be brutally honest. Like, maybe I'm not very good at reading springs or up thrusts. I know I was very weak at that for a while until I spent some time on it. And I had to tell myself, well, don't trade them until you really understand them. And the best way to do it is through journaling. Either it's good to journal on the website, or it's also good to write it down by hand too, because there's something about physically touching a piece of paper and writing your thoughts down. You actually connect with it more than when you're just typing it. Some examples of things that you don't notice till after the fact. I remember one morning I was having a little issue with my trading platform, but I could still enter trades. It just wasn't integrated into my platform. Well, I saw a trade setting up. I'm like, well, I need to reboot. So I passed on the trade, and it was in the morning. It was in the first 10, 15 minutes. I rebooted it, pulled up. And of course, it was a great trade. And I went back, and I didn't think much of it at the time. I go, well, that's just how it is. My system wasn't working properly. But when I went back and analyzed what really happened, I realized I was just trying to avoid pain. I didn't want to take a trade in the morning because I wasn't feeling comfortable for whatever reason, and it was a solid signal, and I had an excuse to kind of get me out of that, and it's called pain avoidance. So I avoided the pain, but that was very short term. The pain of missing the trade was actually worse than the pain of taking it, and I had no reason not to. So that's just one example, and these are things you don't notice until you journal it and think about it.
When it comes to psychology, people know pretty much how I feel because I go on and on about it. And I try not to, but when everyone on the forum tends to be focusing on methodology, and not just methodology, but focusing on entry, not even exit. Very little focus on risk, very little focus on discipline, and very little focus on psychology overall. So like you, I believe it's the exact opposite many times. And I encourage everybody to do the journal, whether it's on BMT or not, because it's really going to be an eye-opening experience, because your mind is a very powerful tool, and I can absolutely say with confidence that it lies to you. You will remember a trade a certain way that is false. You will be 100% confident, but if you actually journal it and as close to real time as possible, it doesn't have to be long entries. 3 or 4 words is sometimes sufficient, and you go back, you'll find that your memory is deceiving you more times than not, and the journal doesn't lie. I like to recommend that you go back and read, like on the weekends, if you go back and read the last 1 or 2 weeks of your journal entries, it's going to be just mind-blowing, eye-opening as to what stands out. It'll be obvious to you the areas you need to focus on, which you may not know from day to day. So I can't emphasize it enough.
Yeah, I agree with you 100%. And it's not until you start doing this that you really improve, because your ego doesn't want you to think that it's you. It wants to think it's an indicator. So generally, to relieve that pain of like coming to grips that it's actually you and you're responsible for it, you try to relieve that by trying to learn something new. And now, don't get me wrong, you have to learn how to trade, right? And there are times where there's going to be big holes in your strategy, and that's where having a mentor helps. I mean, it helped me out immensely with Gary, kind of going over with me and kind of pinpointing, because I don't know what I'm doing. What did I do wrong this week? Was it technical or was it psychological? I don't know. Well, it's nice to have someone to look at that. But if you journal it, then you could really kind of go back on the week and kind of see a pattern that you wouldn't normally. And you tend to forget what happens if you don't enter it right away. And so, yeah, I agree with you 100%. It's something people neglect, and they really should pay a little more attention to it. Another thing too is routine, and trading's not like a job where you have finite work to complete or a specific deadline. It's very abstract. So a lot of times you feel off ease. So you kind of have to build your own structure so you feel a sense of security and a sense of being on solid ground. And so it's good to have something that you do every day to kind of build a routine, and a routine when you're trading too, something you always do. Like I label my charts like crazy. I make sure I always mark all the no supply. I always draw my trend lines, and then when I enter a trade, I write a list of things that I look for context that reason I've taken it, and then what my entry was based off of. Was it a spring or up bust or a 310 or a no supply? And it helps me. It gives me something to do. It makes me realize that I'm not just shooting from the hip, and it makes you feel more secure in what you're doing. And it even comes down to little things like certain things help put you in what's called an alpha state, and professional athletes do this. Jordan had this before he went to a game. Every time he went to a home game, he always picked a certain car. He took a certain route. He had a certain music he played every morning, and he had a certain thing he did in the locker room every time. And it put him in a state of alpha where he was kind of more relaxed. He was coming more from an intuitive point of view. So for a trader, that could be many things. It could be meditation. I generally do like a devotion or prayer in the morning for myself. I always make sure I have something to eat first thing, so I have my nourishment in my body. I turn on my monitors. I label the high and low of the day. I just do the same thing every day so that when I come to work, I feel grounded. And I notice if I don't do those things, I just jump in front of the computer about 20 minutes before the market opens, I rarely trade well, and I feel I don't feel at ease. So I just think it's important to build your own routine.
I don't want to get overly personal, but do you have family at home that, a lot of people have the challenge of, so they're trading from home now, which is fun, which is great, but they have family, they have kids, and they constantly get interrupted. It's constantly somebody at the door, constantly the phone's ringing, the kids need to go to and from school or whatever it is. Do you have to deal with any of those things?
Yeah, I do actually. I've got two kids. I got a 1-year-old and a 3.5-year-old. So we've actually, my wife's been really supportive in helping kind of keeping them away from me. And it's real important to have that because
Yeah.
any distraction you got, I mean, even if you don't have kids, the TV in your room, surfing the internet, watching YouTube, those are things that can really, you don't realize it, it's so subtle, but it can be the difference between you making money and not making money on a day. So
Right.
you have to be focused, and you've got to, one thing that Linda Rashke talks about, and it's really kind of cool, I think in the morning, every 10, 30 minutes, she writes down what she's observing, and she writes it by hand in her notebook. Now, she never looks back at these things, but it keeps her connected to the market. If she's just sitting there thinking about it, looking at it, it's easy to move your focus. But if she makes a point every 20, 30 minutes to write down, like, okay, we're nearing support, there's no supply coming in, even if it doesn't really help you out much in your analysis, at least it puts you focused on what you're doing. So, but yeah, I've definitely dealt with those things, and you definitely, if you have this situation, it's something your spouse has to be on board with you and kind of understand why you need it, and because it really helps. So that's pretty much it. I just encourage you guys to focus on psychology and context, and and then go from there. Don't put too much focus on entries because they really don't matter unless you've got some sail in your winds and you got a clear mind to notice what's happening. Otherwise, you could just be spinning your wheels.
Right.
But,
well, Trevor, I want to thank you. I thought it was a fantastic webinar. You did a really great job, and I really appreciate you taking the time to do this today and to put the entire presentation together. I know it took a lot of effort. So if anybody has questions, now's the time to go ahead and ask them, and we'll see if we can get a few of them answered before we leave today. Okay, so I'm not sure I understand this question from Jeff. He's asking, how do you get in touch with your mentors? Maybe he's asking if you do it by phone or email?
Yeah, with Gary and David, they're actually really reasonable, really reasonable. I mean, and very generous with their time. I mean, they say it's an hour, but they always go over. And they're reasonable. So if you want a mentor in this, obviously first I would do the basic groundwork, like if you're interested in Gary helping you out, do his I think it's a month-long Wyckoff course, and it's really in-depth. Really focus on it, put a lot of effort into it. And once you get that down, then go to Gary or even David as a mentor. And what I like about Gary is he's very practical, and I mean, it's very rare to find someone that will do that, and especially someone who's a good trader.
Right.
There are a lot of people willing to mentor you that don't know how to trade, and they're hard to find. So I don't know of very many of them, but he's one. And so just go to his website if you need to contact him. He's got a tab on there for one-on-one sessions. You can buy a bulk of 4 of them or just one session. But I would encourage you, it's worth the money just to do at least commit to 4 of them, and then first commit to learning the material, and then, because you don't want him just teaching you the basics, it's kind of waste of money. But once you've got the basics and you really understand it, he can help you with the application and the psychology.
And excuse me, just so everybody knows, Gary's done probably 4, maybe 5 webinars on BMT. I highly recommend them. And then in the main webinar thread for this webinar, I put a link to Gary Dayton's website, so you guys can check that out. Wayne is asking about swing trading. So, how much of this would you say applies to swing trading, or how much of it does not apply to swing trading?
I think it applies any time frame you like, really. Obviously, the pivot points maybe not so much, though I do know that Gary will look at like a monthly high or low on a bar and say, oh, if he's looking at a daily or intraday chart. So, oh, we rejected the monthly high, and so he'll look at that. But the rest of them, not so much, like the opening price, probably not. But all the other things, all the Wyckoff concepts, I think probably even work better on like a longer term charts when they're clear. They can turn into really big moves, especially the springs and up thrusts. You know, if you want to focus on Wyckoff, I think that'd be the first thing to learn, because you could apply it. You can apply it right away. Gary's got 2 webinars, and they're not that expensive. And you can just pick one of them, just up thrust, and learn just the up thrust, and you can kind of think in the reverse for a spring. But it's a good way to get started in Wyckoff. And David Weiss has said you can make a really good living just on springs and up thrusts if that's all you traded.
Right.
So
it's kind of like looking at it from the trapped trader's approach, right?
Exactly. Yeah, they call it bag holding, where if someone's under the support level with their bag open, capturing all the buys, and then once they're done, you know, they close their bag and it shoots up, you know, through the roof. So yeah.
Andre is asking, were you able to trade whenever you had a regular job, you know, a day job, or do you think that a newbie can learn to trade while he's also keeping a day job?
Yeah, you could definitely learn, and you can even trade. Just be mindful that you're not going to get as many signals. You know, one advantage of day trading is you get to practice 3-4 times a day on executing a trade and reading the market. Whereas with a swing trade, unless you're trading a lot of different markets, you may not get a signal for a couple months in one particular instrument. So you have to look at more instruments. But if you're a newbie, I would, you know, there's no reason you can't. In fact, it might be better because you can take your time. You don't feel the urgency to make money right away.
Yep.
And you can,
I agree.
Yeah.
I mean, a lot of it, we're just mentioning how big psychology is, so do yourself a favor and take some of the burden off, some of the stress off, have a day job, have a regular paycheck, and then take your time on becoming a profitable day trader. And one last thing I would say is increase your time frame. You know, start with swing trades, because that way you can manage them more easily. You can maybe, you know, do your research over the weekend and then just keep in touch during the week, and you don't have to, like, you know, have your charts up, you know, and hide them from your boss during the day.
Yeah. Exactly. And you could, and I've heard you say this too, you can even trade, you know, a really small position in, like, you know, buy 10 shares of the Qs. And that way, then you have a little skin in the game, and you're actually getting a feel for the adrenaline you get and how to deal with that, because that's most of it. It's like, how do you deal with yourself when you're in a trade?
Yeah,
you know?
I'm a big believer that sim is only useful to, like, really learn the platform, and then you should put some kind of skin in the game. I don't care if it's you know, $5 a day, a cup of coffee, you know, something, just so that you start experiencing the real emotions of trading. Let's see what other questions we've got. A lot of people saying thanks. So once again, good job.
Oh, you're welcome.
Gary wants to know if you can talk a little bit more about interpreting the Weiss wave at turning points. That's up to you. I felt like you went into a lot of detail, but we don't really have too many questions left, so it's up to you if you have time for that.
Sure, yeah, I'll show you some examples. Let me go back on some of these slides here. Oh yeah, this is the right one. So interpreting the Weiss wave, really, you got to compare it relative to what's happened in the past is the best way to describe it. So, for instance, on this one, you know, I pointed out this is a pretty high demand. Well, how do you know how? Is it a lot? Is it a little? Well, compare it to the beginning of the move. So really, you got to figure out where this move began, which was here, and look back and see what was demand like back there. Well, there was very little demand and lots of supply. In fact, this is the most demand we've had since this move began. So you know that someone stepped in there and started buying it, and they were willing to chase it all the way up to here before sellers finally took over and they brought it back down to test this level and see if the buyers would show back up. And surely they did, and they started pushing it up. So that's probably if you just take that away from this, compare it since when the move began, then it's going to give you a lot more obvious idea what's happening. So let me show you one more example. Two, you can also see if it's extremely high and we've we've had a pretty big down move. Like look at the size of this down move, and we started from here. This is exceptionally high, and we've already gone from top to bottom about 20 points. So here it's the opposite. You're kind of looking at this, and David has mentioned this before. You become suspect of high volume after a prolonged move. So that's another way to interpret the really high volumes. And then the really low volumes is what you use to kind of figure out when you're going to get in. And the really high volumes is when you're going to try to figure out if we're going to turn or if we're continuing a down move. And the ones in between just kind of ignore. So hopefully that kind of answers his question.
Yeah, I think so. Juan is asking if you use VSA on tick charts or only no supply and no demand concepts with the Weiss wave.
I actually don't really use it on tick charts. The volume on bar by bar just isn't very. It doesn't really tell you much. So yeah, it doesn't really work on tick charts. I think I had their software for a while, and I tried it on a tick chart, and it just didn't really give very good signals. So
okay.
Probably use that on a 5-minute. And I do use my 5-minute in conjunction with this as well, because there's some things you can't pick up on that the 5-minute bar by bar might. But structure is the same on all of them. If you see this trend channel, it's probably going to be oversold on the 5-minute bar chart too. But what I like looking for is when I want to exit. I think one reason I exited here was there was a really high volume bar that ended up went up and then closed on its lows. It was telling that selling was coming in, so I just got out of my trade because of that. So I will use VS. That's a VSA idea, so I will use it, but not on tick charts.
Okay, well, Trevor, one last time, I'd like to thank you again for everything that you did today and answering all the questions and all the presentation work.